Welcome and greetings to everyone. So today we are group 5. We'll do a presentation for our group assignment. Our group consists of 3 people, which are Farah binti Amir, Adrina Batrisha, and Aida Batrisha. Firstly, the expected return and weightage for stocks and bonds are calculated and listed in the table. By using Markowitz portfolio theory, the expected return portfolio is 20.24%. By using CAPM theory, the expected return portfolio is 7.75%. The standard deviation for portfolio was calculated by using Excel. The formula used for standard deviation portfolio is as shown in the slide. Beta portfolio is calculated by multiplying weightage each of investment instrument with their beta, and we got 0.788 for beta portfolio. Lastly, the Janssen alpha is 12.59%. Next, an arbitrage opportunity can be created with this portfolio. This can be proved by the graph provided in this slide, and the CAL and also CML line graph also shown in the slide. Next, for security analysis, we will do a regression for both stock, target corporation, and Procter & Gamble. In a systematic risk equation for target corporation, unemployment rate is defined as UR and consumer price index as CPI. If unemployment rate and consumer price index rise by 1% and beta unemployment rate, which I found in regression, is 0.0473 and beta CPI is negative 0.0084, the stock is expected to have 5.1633% excess return. While for Procter & Gamble, if unemployment rate and CPI rise by 1% and beta unemployment rate, which I found in regression, is 0.0176 and beta CPI is negative 0.0017, the stock is expected to have 3.72% excess return. That's all from me. Next, I will pass the floor to Aida to continue the presentation.
Thank you, Farah. Next, I will continue the presentation to explain about the technical analysis. So, we are using the 20 days moving average for both stock, which is target corporation, and Procter & Gamble. For target corporation, it shows the sell signal because the price is below than 20 days moving average, which is the price is 149.04, and the 20 days moving average is 158.50. As for Procter & Gamble, it shows the buy signal. Since the price is higher than the 20 days moving average, the price is 151.89 and the moving average is 140.85. Next, the investment instruments that we use are bond, stocks, and futures. And for our fund objective, we have 4 fund objectives. The first one is to protect companies' wealth during inflation. The second one is to gain a larger return from the revenue that we earn. The third one is to build a diversified portfolio that encompasses multiple industries. And the last one is to lower the risk. So this is how we calculate the intrinsic value for both stock, which is the target corporation, and Procter & Gamble stock. As for the growth rate for target corporation, we got 0.1055. The dividend per share, we got 3.69%. The required rate of return, we got 0.1341. And by using the formula, we got the intrinsic value for target corporation is $171.41. As for Procter & Gamble, the growth rate is 0.0618. The dividend per share is 3.61%. The required rate of return is 0.0860, and the intrinsic value we got $214.14. As for hedge futures, the first thing that we need to find is the fair value of futures contract by using the spot price, which is 3,895.01. The interest rate is 4.7056%. The dividend yield is 1.74%, and N is 355. By using the formula, we got the fair value of futures contract is 4007.36. And next, we need to find the hedge ratio. By using the amount to invest in equity, which is $80 million, amount to hedge is $20 million, and the beta portfolio is 0.788. And by using the formula, we got the hedge ratio is 78.65. And it means that there are 78 contracts that need to sell in order to stop loss. That's all from me. I will let Adrina to continue the presentation. Thank you.
Thank you, Aida. Next, I will be explaining about the estimation of annual return. The assumption for one standard deviation is equal to -6%, and for -2, standard deviation is equal to -12%. We get to calculate for the negative standard deviation and positive standard deviation from the spot price at 0, which is $3,895.01. Next, we calculate equity portfolio value from the weightage, which is the 80% from the fund, and equals to 80,000. The bond value is 1 million and the dividend paid is 1,974,363. The future value we get is from the hedge future, and last, to calculate net profit, we sum up from the equity portfolio value until future value. For market risk, we get to identify risks about unemployment rate risk, interest rate risk, exchange rate risk, and commodity risk. High unemployment damages the company. Food stamp may cost more for state and federal governments since the unemployed people spend less and may fall into debt. Low unemployment causes inflation and less work. When the labour market reaches slack, new jobs don't boost productivity enough to cover their costs. For interest rate risk, if interest rate change quickly, the market is likely to become even more unstable. If the Federal Reserve rate rises, US companies may borrow less and invest less. Exchange rate risk, currency risk, or foreign exchange risk is the risk that comes from changes in currency prices. Depending on how the exchange rates change, it can get cheaper or more expensive to buy assets inside the countries. For commodity risk, if there are changes in politics, rules, or the weather, the prices of commodities like crude oil, gold, and corn could change quickly. For unsystematic risks, there are risks about financial risk, operational risk, legal and regulatory risk, and investment and infrastructure risk. For financial risk, the capital structure of a firm is linked to the financial risk that it faces. In order for a company to grow while still meeting its financial obligations, it is necessary to strike the appropriate balance between the equity of stock and debt financing. For operational risk, careless or unplanned situations such as a supply chain failure or a manufacturing process oversight of a critical fault can cause operational hazards. Legal and regulatory risk, a change in legislation or regulation may have a negative influence on an organization. These changes may result in increased operational costs or new legal constraints. Investment and infrastructure risk targets competition position, financial health, and operating result could be impacted. If it's capital investment in renovating stores, opening new ones, boosting technology, and expanding its supply chain infrastructure, do not really yield off enough returns. That's all from us. Thank you.